Hey, hello friends, this is Martin from Secrets, the channel for learning about trading and investing. Welcome to Markets Next Week, the weekly stock market analysis show where we look at technical charts and try to understand what happened in the previous week in the market. Now we can plan for a better trade for the upcoming week starting tomorrow. Okay, so lots of things have lined up. We deep dive into Nifty, Banknifty analysis. We look at some of the for currencies and commodities and all that. We do some stock analysis as well. So in a nutshell, we will trade with a plan instead of randomly taking a trade. We try to analyze what exactly happened. Let's deep dive. So this is a chart that you see here. It's a trend line, almost like a parallel channel, and price has been moving in, hovering in that with interim corrections that has been happening, and now another one is ongoing, and we are at the bottom of the channel somewhere. This is a weekly view basically, right? And right side you see is the daily view of Nifty, and that was Nifty 50, right? You can clearly see that it's on daily charts that it's in a trend line channel, and it is somewhere mid, a lot of space to go down towards the bottom of the trend line. And the weekly analysis shows that this trend line is not run properly, but it just move a little up there. But notice it used to be a ascending wedge, which is expanded the trend line. It looks like still it's an ascending wedge, you can see, and price is at the bottom. By the way, this is a Banknifty's weekly that you're seeing on the left side, and daily. Daily you can see that it's a parallel channel that got breached. Another parallel channel movement is happening up and down. So some more space to breach and make two new lows. Previous lows, recent one in January, has not been breached yet on daily charts. So you can clearly see that on the Banknifty. So Banknifty, in a way, in better shape than the Nifty, but Nifty shows all the weakness, right? So let's see bird's eye view of weekly and daily charts of both analysis. That's what it looks like. So what happened exactly was last week was mostly flat, usually up 0.6%, 136 points down on Nifty, and Banknifty is only 0.23. It's flattish, only 100 points lost, right? But regardless, it's a negative close, and it was very weak. It continued to be weak. It made a new single in the case of Nifty, and it was weak, volatile, and intense. Both indices are like that. The correction is extended to 13.5. It's nothing compared with 72% of rally in the upside. And if you still, the max correction is from the top is 12.1% so far, and both of them are below the 20 exponential moving average, and that's the summary. So it's a correction going on, but the thing is, if you look at the candles of the daily, you can see that it's a indecisive close, a small body doji close that has happened. Gravestone doji in the case of weekly, and normal doji in the case of weekly for the Banknifty. No, in the case of Banknifty also it's an ordinary doji, right? You'll see that here. See, look at this. It's Nifty. It's a gravestone doji. So any doji is indecisive. Gravestone doji intensifies the fact that there is sort of selling pressure. The wick size indicates that, and it's a bearish indecisive indicator. Also, any indecisive indicator at a major support zone of 23.5. That means that market has been retesting this. Next thing that may happen will be huge for cracking down from here, right? Mostly, or it could be a reversal from there, big reversal from there. Those market is indecisive. You don't know what's going to happen. It's a very crucial support zone of 22,800. Did I say 23 earlier? Sorry, 22,800. That's a support zone where price is hovering around since 3-4 weeks. It's finding that as a support zone, right? The more it remains there, more likely that it is breached. This doji indecisive candle could probably mean a reversal as well from here, or it could be a big sharp fall down. Right, so that's the scenario. On the Banknifty, you can see that it's a doji. It's a small body, almost a doji with huge volatile wick size that you're seeing. The weekly candles we're talking about, and it's all the Banknifty. So it's again indecisive, but overall, if you do, it's in a consolidation phase. If you look at the 4 weeks back scan, the big up move attempt to move up after falling below the 48,000. So it's still consolidating within that range. So that way it's consolidating. But Heavy weakness can clearly be seen with a lower low, lower high pattern on the left side weekly or the medium term charts of the Nifty. Now, daily charts help us to understand what happened during the last 5 days. It was volatile, definitely, right? And it was mostly flattish by the end of the week, although the first 4 days were very active. The Friday just maintained and overall became flattish. And daily charts of the Banknifty is showing that same, the volatility of up and down and almost a flattish close. Another interesting fact that's not having a chart here is that in the monthly, 5 consecutive red candles it is appearing on the Nifty index history in the history first time. So that's really indicating the bearish. So you got to keep that in mind. So it's heavy bearishness is what probably the case. That is a change in pattern historically. Right, so that's about it. And all demands are clearly showing expansion on the downside, which indicates more downfall. In the case of Nifty, but look at daily charts we're talking about. But look at what's happening in the Bank Nifty. It's not bearish, it's absolute consolidation or absolute sideways is what is anticipated. Clear contraction of the bands of the Bollinger Chart can be seen here. So that way, another reason why the Bank Nifty is more strong relatively. Swing low is not touched in. And one more momentum factors also, we come to see that later. And also the Bollinger Bands is consolidating and not an expansion downside. And so that's the contrast between the two indices. Divergence or variance that you're seeing between normally the index, both of them more or less behave the same way, but that's not the case now. Slide better strength in Bank Nifty can be seen. Just to wrap it up, that's it. It's a week, not a not a week. It's a week. W-E-A-K. Weak in the sense it's unable to move up. It's fine hitting resistance, and it's just weak size indicates that it's been pushed down. Huge resistance in the zone. Volatile in the sense that it moves up one day, next day falls. So the week it is in a range up and down, very volatile. In the sense, finally the end of the week-to-week basis, if you see nothing has happened, it remained where it was last week. So that is in this series in the rest of the market. That's what the next step can be. The Bank Nifty has been seen slightly better pushes. Okay. Candlestick wise, momentum wise, and Bollinger Bands wise, and for the factors. Now let's move on it and try to understand what is the momentum indicator RSI and the trend indicator ADX is talking about. Left side you're seeing the Nifty and Bank Nifty. That's on the weekly. That left side, right side you're seeing the daily candles. So momentum clearly has fallen into the red zones or the bear zones below the RSI 40. So momentum is still bearish on medium term and on the Nifty, right? And right side if you see momentum on the short term also, daily charts also it's bearish. So absolute momentum is turned to bearishness on medium term and short term. But Bank Nifty, look at this, momentum is still sideways on the medium term, and the short term also sideways. So Bank Nifty, the momentum is showing strength, but Nifty is weaker and weaker. So somewhere this has to catch up. Either the Bank Nifty may catch up along with the falling, or Nifty may catch up along with the Bank Nifty and rise. So that is happening. That's the interesting that we're talking about now. Overall, trend indicator ADX is showing bearishness. Absolute. Both indices bearish, both time frames bearish, in depth and short of both. So, absolute bearish trend, and a contradiction in the momentum with respect to bearishness. In the case of Nifty and Bank Nifty, the Bank is struggling to in the sideways zone, not at touching the bear zone so far as I can afford. So that's the story. Now, another indicator is the India VIX indicator. That's another way of finding the volatility apart from the Bollinger Bands. Volatility index is showing 3.5% cool off actually, right? So that's about the edge of that volatility regime of 15. Anything above 50 is considered to be high volatile. So it's almost there, but slightly slipped down. So that's the story of the India VIX. So some kind of fear factor is still there. It's not cooling back to the 10 levels or 11 levels. Probably the Trump tariffs and reciprocal tariffs or more clear in the coming weeks, that fear may still be there. Ever since Trump has taken, results have come in November, all markets have been correcting. Since then, and that continues after 20.5% of correction. It's still waiting. Some fear factor still there is what the VIX is indicating. Now, although it has cooled off technically. Now, open interest analysis is the next section that we're trying to see. This is one way of finding the levels of support and resistance. One way of finding that with the help of the open push, the open contracts, right, of the options and the futures. The futures II Friday build-up is definitely a short build-up. That's bearish. And next we have the monthly expiry on February 27th for both the indices, Nifty and Banknifty. And the options PCR put call ratio showing bearishness again there, 0.7. So our II showing bearishness. And we can find the OIP support resistance level more or less the same as last week. The highest put and call writing is seen at 22,500 and 23,000 Nifty, and second highest is 22,300 to 23,500 where the highest put and call writing is seen. So that's a pretty 7-point range that you've seen, right? But the price, we still have 4 more days, and monthly expiries are often volatile, so anything could happen. Banknifty, monthly expiry has a range of highest put writing at 49,000, highest call writing at 50,000, 1,000 points, rather narrow for a monthly range. And second highest put and call writing is at 48,000 and 49,500 ratio. And futures II is bearish. We have already seen that, so that's one way of finding the level. Support resistance levels can also be found from these charts. Right? This is Banknifty, this is Nifty. So Nifty, basically what we check is Fibonacci levels or exponential moving average levels or previous swing lows, previous swing highs, previous resistance zones, gaps, and all this. So clear. The first resistance will appear with Fibonacci 16 and 23, 115. You also have that confluence with 20 exponential moving average. So that's going to be clearing the 23,000 rounding number and then going about the 23, 150 is what the challenge. That's the major resistance. And after that, you have the 23. 450 where the 50 exponential moving average is there, and 23,660 that's for the next resistance of the 200 crucial exponential moving average. And close above here the Fibonacci at Fibonacci 50 at 23,750, and you also have the 100 exponential moving average that company us at this 23,750 zones. And beyond that, the next stop would be 24,000 big rounding number since it's comes in the downside. The first thing would be the previous swing lows that comes below the 22,720, and if that is breached, then Fibonacci 78 at 22,340, and then 22,000 rounding number. So that's how the levels are indicated here. RL is rounding number with this Fibonacci. 20 DMA is exponential moving average. Previous resistance is what PR is. Previous swing low is what PL is. Now Banknifty, if you see, similarly you can see the huge resistances that can come into play at 49,000 and 49,425, then 49,550. 49,930, then 50,000 and 50,187. It's all mainly rounding numbers, Fibonacci and the exponential moving average versus the downside. The first major swing low will be retest of the previous swing lows at 47,876, where the Fibonacci 78 also is coming in confluence with the swing low. If that is breached, it goes to 47,000 nearby, where you have the previous swing lows, 46,947 to be precise. Then 46,574 is the previous swing low next after that. After that it goes to 46,000. 77 previous swing low and 46,000 rounding numbers down here, right? If at all that breach happens, but most likely there's going to be sometime that may be spanned at the bottom or of this channel if it all is coming down. So that's how resistance levels and supports based on the chart is indicated here. Based on the OI, it's indicated in the bottom columns. Let's try to understand how the sectoral indices have performed. Our light index has gone down. Autos has gone down, pharma has gone down, FMCG has gone down, realty and metal has come up. Metals done a beautiful comeback, 5%. I think more than 5% was given the previous week, and it has recovered completely. But apart from the metal and the realty, all the other sectors are down. Even IT is down. IT systems. None of these are worth taking risk on the long side. They're all either short trade opportunities or wait and watch. Right, till the moment it picks up. It's all with the PF zones, all of the different sectoral indices, each of them are sectoral major indices that you're talking about. The charts are the same are shown here. So you can see the IT that is falling down in the sideways momentum, and you can see the metal that's trying to hold on the channel bottom. You can see the auto that is slipping further down towards the bottom of the channel. You can see the farmer breaching the channel and free fall down. Right? So farmer seems to be having big trouble there. And you can also see FMCG slips have reached that parallel channel bottom, trend line parallel channel bottom, and the flag is done with, and it's also breaching down, slipping reality indexes for a lot of way to go down. So but this week it managed to close green along with the metal, but that's the overall picture, right? So no differences are not helping FMCG and pharma and all that is the IT. These are the indices. All the three of differences indices are red and having trouble. So that's why market is. Indices are struggling just because of that reason. Now, if you consider the different heavyweight stocks that contribute maximum to the indices, you can find HDFC Bank, the biggest contributor, is sideways and struggling. After having a correction, it was trying to recover, and it is having a very volatile doji kind of candle, somewhere in the middle, a lot of space to go down in the parallel channel. Momentum is in the sideways move. Reliance is actually having a momentum divergence, which is very positive. It had corrected substantially and is holding the 1200 points. There's a possibility that it can go and hit that 1100 also. But this zone for picking up the stocks with good correction has happened. There's a divergence, and the charts also indicates that correction probably may be done with. But if it bridges also, it may go another 100 points down. IGC Bank is on the correction mode. A lot of space to the bottom of that parallel channel, very long parallel channel. It's one of the strongest stocks, and even now it's only sideways, just like it. So, two banks are holding the market, which is not found. We have zones and Reliance also has the potential to come back after corrections. And the ID stock hit hard. There's a couple handle, there's a parallel channel breach in the TCS, and Nifty is also consolidating, but TCS has got something badly hit last week. The momentum has slipped into the zones after a long time. ITC is the next one. It has almost breached the parallel channel at 400 and breached format also once. Momentum has slipped into gear zones in the medium term. Caution. But that is a good stock, which gives good dividend as also probably. Even if it reaches, it will be opportunities for it to buy. Kodak, as usual, it's moving up and down. Right now it's in the upward trajectory, but it's consolidating between 2000 and 1600 since very, very long. That's how it is. So that's about the industry. Heavyweight stocks that can loot up. So banks are doing good. That is having trouble. Reliance is recovering, and ITC also having trouble. So ITC is the one that's having trouble basically, along with the IT index last week. Right. So banks are doing good in the index heavyweight stocks. Moving at the broader market indexes, if you see, it's trying to hold on to the bottom of the channel. Last week was greenish, but momentum has slipped in the bear zones on medium term, so try to be cautious. It had done vertical moves, and therefore the corrections has more space to go. Especially in small caps. So small caps, small cap index or in deep trouble continues to be that. But last week it didn't fall further down. It did make a new swing low, but recovered quickly and tried to hold on within that channel. Although the momentum has slipped in deep red. And institutional participation, if you see, foreign institutions have sold nearly 8,000 crores last week also. Although there's a small buying that came in somewhere in the middle of the week, you can see that. Right, Tuesday or something, they bought in some, I don't know for what. But immediately they continue deciding that's a buy that has happened after a very long time. A very small buy the previous week also. One day they buy, 5 days they sell. That's how waves. But domestic institutions has steadily been buying, nothing but buying. Those 16,500, that's where the market is holding on at 22,800 levels just below domestic institution buying. So net long moves, net long some derivative sides for the FIDs have moved down last week. That's the story that you can see here. Right. Now, moving ahead, we try to understand the global markets. That's the US market primarily, the global commodities and some currencies. Let's bring the currencies. It's down and again currency slightly 0.15. You can see that here. The US dollar is what we're talking about, sideways and falling. Just trying to move up, has been correcting, cooling off, which is good for us. Now 6.64 is what dollar has fallen to from the peak, from the attempt to move up, basically not a peak. It had gone for for the further upward the 115 all, but yeah, it has been consolidating. It broken out of that consolidation box and then could not move up further. Now it has slipped back to sideways and through. And USD now currency pair had made a steep correction after hitting the all-time high, which is due to Reserve Bank's intervention, and now it seems like it was a close flattish point, so to 86.59, very flattish close. And it seems like it's going to hang on there at 86.5 levels for a long time, because it is moved to 87 plus levels after having broken out from that. Balance channel still is a lot of space on the upside, but it's a relief that the bullishness has slightly taken a bend. But regardless, rupee is still weak. Crude oil had taken a beating, continues to move towards the downside near to the 70 levels, which is relief and good for our market, Indian market, emerging markets. So, gold is all-time high, record nearly 2% up and bullish momentum, and 80% rally just in from the last week low. Huge move. Very huge move. Now, ever since the Trump had come in, gold is shooting under like anything. Because people are finding safer haven with gold than equity markets. Money is getting pulled out and placed at gold. Gold pricing up as hedging is good, but it gives a worry that equity markets is it really in trouble or not? That kind of questions comes in. So I'll be cautious on that factor. So US markets, Dow Jones has been final and Nasdaq, if you see, for some reason deep red Nasdaq deep red has been final, all of them. So momentum is of all of these have slipped from the bull zones to the side and slightly falling. So I don't know what is reason. The Trump after the Trump was sworn in, the very good new term high breakout had happened. Now there is a deep red week. So whatever be the reason, the mother market having trouble in the stock markets is going to impact the smaller markets like ours for sure. That's about the analysis on the global cues. Basically, global cues are okay-ish, except that gold is shooting up and the US market is red. Otherwise, things seems to be okay. Although the factor of weakness is there since a long time. Hope that Reserve Bank will take care of that. Now we move into some actionables now that the analysis are two on the short side, both the Mother Hospital. I could breach that panel channel, almost breach that and try to climb back. So on the mostly all the weekly maintained momentum slipped into the zones and try and move up. But if it goes below the previous day's low, then there is an opportunity. Wait for absolutely no entry if that is not reached. That will give you what I should to RiskReward. Given the fact that we have some second somehow can train it after make book the profit detached. The trend is a Tata commits in the FMCG. It is also in a very crucial zone. If it moves below the previous candle's close, probably that may be an opportunity that could extend and give a initial RiskReward. Because momentum will also slip in the bear zones on the medium term. Trend is bearish. Volumes are big enough. RiskReward is decent enough. Patterns are showing almost a head and shoulder also. Something like 9. So there are confirmation that the candle of previous week low or close of that is breached for the making entry. Have tight stop losses though, because trend is a very good stop. It's just the correction period. It's a Tata stock, I believe. No, it's a Reliance stock. Trend is Tata. Right, so yeah, so two on the short side, Apollo Hospitals and trend. Once again, this is not recommendations for trade. This is just for you, help you to go look at the charts yourself and then try to understand what the patterns are talking about. It's for education purpose only. Trading is your individual decisions. I'm not an advisor, I'm not heavily restricted. So if you want to trade, you look at these charts, and if that convinces you, what I said, convinces you also, if you have the conditions according to your risk appetite, you invest, trade, or whatever. It's up to you. I don't care. My job is only to convey some ideas for you to help pick your own stocks later on based on this similar fashion. Probably after seeing this analysis for a few months, you can do the analysis on your own and then come to a better market view than mine. Right? Hope that helps. Now the Avalon. Therefore, strategy for the next week is again a bear call spread on the Nifty. It's a monthly expiry. So this is a bear call spread where you're selling near ATM and for OTM buying. So the profit will cut short because you're buying insurance. So but it is in probability of profit, and then it is into RiskReward, and then estimated margin requirements are also very less. So any fall that happens in downside, you make profit. Most likely that's what may happen. Even if it consolidates, it's fine, but if it is closing about 23,000, you have trouble exiting if that is the case. Right. So it's a weekly strategy. We have 4 more days for the week to complete, and this is a fully risk defined strategy. Again, it's not a trade recommendation. It's for your understanding and education purpose only. But just to wrap it up, market remained indecisive and volatile and weak, as I said multiple times at the beginning of this slides. So it made new swing lows, but tried to climb back and close above at that 22,800 zones, and then close flat, 90 flattish. 13.5 correction is what it has done so far. The fractional set of effects continue to sell, while the bears have taken over the momentum and the trend indicators on the medium term and the short term as both. But remember, the 13.5 is nothing compared to the 70% kind of rally that we've been seeing since 2022, 3 years. Not 3 years, 2.5 years. So that's the story. Now we're trying to bucket two of the different factors in favor of the bulls and the bears. Very few things are left for the bulls at this point in time, because the Banknifty is not reached the previous lows and still showing a contraction in the Bollinger Bands. This is only 2 things that being talked about. And also the momentum of the Banknifty is not turned to the bear zones yet on the medium term, so that also gives hope. So to add that, but that can also be added. So Banknifty is only hope basically. If you try to bucket the things or factors sells in favor of the bears, lot FS continue to sell, US markets in red, open interest for the options, PCR is bearish, futures are in short build up, lower price action, momentum bearish, trend bearish, so trend rise is bearish, heavyweight stocks mostly sideways, and ITC fall into bear zones. Major sector lower market is in bear zones in the medium term, hit badly. More than that, below the 220, all this is mentioned on the average. So there are factors in favor. So in a nutshell, I give a moderate bearish bias based on the charts. Probably it may find a support at 22,800, then because the Banknifty is strong, it may lift and then bounce. But chartedly, it's weak. Based on all the different factors that we talked about, it's a market for the next week's moderate bearish. So there's US tariffs and all this, a number of volatile global cues that are coming, and this group. The technical analysis selling is very intense for some reason or the other. There's a tariff fear that's always there. So when there's a black swan event that happens, like war or recession fear or some interest rate cuts, and all these major events when it comes in, technical charts may not work properly. May just get screwed up in the black swan. So keep that in mind. Technical analysis only for probabilities of places where there may be support resistance. It may help you to trade or invest or place your bets properly. Otherwise, you're blind. You can't understand the entire fundamentals in the world, their economics, macro, micro, balance sheets, everything you can't learn, and then you can't place your bets like that. You may go wrong because there may be insider information that may be there, but charts don't lie. It's a people's psychology that's reflected. That's why you follow the technical charts. But that doesn't mean that charts are guaranteed ways to make money. No, it's probabilities that it points you to. You may place a bet or you may not. Basically, what matters is how do you manage your risk. That's all trading in stock market is all about. So for the next week, it's 22,000 and 23,500 is the level that I see for the Nifty, and 47,000 and 50,000 that I see for the Banknifty. So there's no bulls here until it crosses 26,000 to keep that in mind. And 54,000 in Banknifty is conquered. You don't have the bulls anymore, just either consolidating or just correcting even more. Right? So always hedge your portfolio, hedge your positions each of that individually. Portfolio also do that, and that's all I think. Protect your capital, manage your risk. Right? You can also use hedging strategies for getting rental incomes like covered calls and cash puts and all that. So markets correcting may be an opportunity for investors to buy good quality, only good quality stocks at a cheaper price. That may be opportunities. You can also By with the cash equity puts and cover cross strategies, you can, whenever the market is correcting, you can get regular incomes, or when the market falls, you can buy. And if it is not falling enough, then still you make money if you bet on the other side. So different ways. Check out the playlist for more details, and if you like the content, subscribe. Click on the like button, give your feedback, share it with others. I'm also active on the other channels. I'm mostly active on X, so I post some technical analysis in between. So if you're interested, you can subscribe to that as well. That's all I have for this week. Happy trading, happy learning, happy investing. Bye.